For a broader look at the Japanese economy, we have Peter Churchouse. Peter is the advisory director with Morgan Stanley, and he joins us live from our Hong Kong studio. Good morning, Peter. It's good to see you.
Good morning.
Okay, let's start with some of the export data that we had out this morning. The trade surplus numbers for May up 35.5%. That was slightly below the consensus estimate that we had from many surveys of economists. Does this indicate to you that momentum of Japanese exports is starting to wane a little?
Clearly, I think export growth has to slow down in Japan, and I think we've got to see a slowdown in the overall economic growth rate in Japan. But I don't think that really means necessarily that Japan is going to slide back into a recessionary phase at all. We're looking at a global slowdown, generally speaking, around the world. Of course, the slowdown in Japan is going to be driven by a slowdown in demand in the US. It's going to be driven by a slowdown in China as well, perhaps also by higher oil prices, generally speaking. So I think we've got to expect that the growth rate of around 4.5% to 5% we expect this year cannot be sustained, and I think has to slow down sharply going forward into 2005.
How is the domestic economy in Japan doing in terms of keeping up with exports?
Well, the domestic economy actually has turned a little bit for the better over the last 6 or 9 months. We've seen consumption or consumer figures up quite nicely. We've seen domestic investment figures picking up quite nicely. So I think we are seeing a little bit of a shift from an externally led economy into a domestically led economy, but it's nowhere near, I think, of the pace needed to keep the growth rate, if you like, that we've seen from the export side. So clearly I think we are going to see a slowdown, and I'm not convinced that the BOJ is going to raise rates anytime soon and really change its zero interest rate policy in the very near term.
And that was my next question. There is quite a bit of speculation out there in the market, in the bond market, in the FX market, that possibly the BOJ will raise rates. Is Japan even over deflation yet, in your opinion?
I think there's very little risk of ending of the aggressive monetary quantitative easing that we've seen in Japan. If anything, that will be the first thing that will be pulled in. But the zero interest rate policy, I think, would follow that. So I don't expect to see that policy change. I mean, if we think back to the year 2000, the BOJ made a major mistake when it signaled an end to the zero interest rate policy and immediately drove the economy back into recession. With the economy already poised to slow, I think it would be foolhardy on the part of the BOJ to really raise rates at the short end of the curve at the moment. Already we're seeing the long end of the curve. The 10-year JGBs have risen by 40 or 50 basis points over recent months. That's telling us that the bond markets think that the economy is going to sustain at least a modest economic recovery, and that we are edging out of deflation. But okay, we're not in a situation where we're going to cut rates.
Okay, Peter, very quickly, I can't talk Japan without mentioning the Tankan report. It's due next week. What are you expecting?
Well, I think we're going to find basically that the general sense is that the economy is still bubbling along quite nicely, but I think the expectation will be that industrial output will start to slow a little. We're going to be seeing, I think, certainly a slowdown in exports, certainly to China and perhaps also to the US, and I think that's what's going to basically show up in the surveys over the coming month or two.
Okay, Peter, thank you so much for that. We'll have more with you coming up after this short break. That was Peter Churchouse, Advisory Director with Morgan Stanley. Keep it here. You're watching Market Watch on CNBC. Okay, time for more with Peter Churchouse, Advisory Director with Morgan Stanley. This time we are going to shift our focus to China. Growth in China's consumer price index is expected to stay high in the third quarter, but controllable and likely ease by the fourth quarter. That's according to Chinese officials and comments that they made today. The comments come just a day after Premier Wen Jiabao said he is confident China will be able to engineer a soft landing for the economy. Since last year, China has raised bank reserve requirements 3 times and tried to curb investment in red-hot sectors like property and steel. Despite that, the economy grew 9.8% in the first quarter of this year. The government has set a goal of slowing growth to an annual 7% this year. So now all eyes are on whether it will have to hike rates for the first time in nearly a decade. Peter, get in on this. What do you think?
Yeah, well, I think any talk of soft landings is quite illusory, quite frankly. If you're engineering any kind of a slowdown from the heat that we've seen in an economy like China, there are going to be very hard components to whatever landing we have. China's excessive growth of credit, excessive borrowing by undercapitalized companies is going to come back to bite the banks in the backside, in my view. And I think there's going to be some very distressed portfolios out there over the course of the next 1 or 2 years as balance sheets get into trouble and profits tumble.
Investors have certainly been pricing in a slowdown or a rise in interest rates in the Chinese economy by selling 8 shares, Chinese companies listed over in Hong Kong. Do you think the sell-off that we've had so far is an accurate reflection of the potential slowdown we're going to get in these companies?
Well, I think it is, and quite frankly, many of the Chinese stocks that really saw so much of this capital flow in the later part of last year and early part of this year pushed stocks to prices which were really unsustainable on earnings growth prospects and in terms of multiples valuation criteria that we would look at. So I think the market's just corrected back to roughly where it should be, and has just taken the froth off the top of the market. But having said that, I think there will be further downward revisions to earnings expectations in China over the course of the next 12 months. Analysts are always behind the curve and making these adjustments, and I think we're going to see further adjustments here to the downside in many of these 8 shares and many of these red chips.
China does suffer from a shortage of energy. It's a theme that we see again and again in this country. We had some comments at the Asian Cooperation Summit from the Premier that they're going to focus on other forms of energy like coal, nuclear power. How will high oil prices right now affect the Chinese economy?
We'll put it this way: if the economy is going to slow from 9.5% to 7.5%, that will curb a lot of the excess demand for energy anyway. By thinking about nuclear energy and new power plants and so on, that's all very well, but that takes years to put in place. So it's really a long-term strategy, and that's all very laudable, and it's absolutely essential that China puts in place energy and other natural resource supplies that it can ensure that it goes through its development without having bubbles and these sorts of prices. But in the short term, I think you're going to see a big curb to the downside in energy demands anyway, with a natural slowdown in the economy. Okay,
Peter, thank you so much for your time today. We'll talk currencies in just a couple of minutes after the break, so stay right where you are. Time for another short break here on Market Watch. I'm Lisa Oak. You're watching CNBC. For more on the most recent developments in the currency markets, let's bring back Peter Churchouse once again. Peter is the Advisory Director with Morgan Stanley, and he is joining us live from our Hong Kong studio. Thanks for sticking around, Peter. It's good of you to give us your time today. First of all, what are you expecting the U.S. dollar to do before the FOMC meeting next week?
Well, I think if you like, the sort of big cyclical correction that we've seen over the last couple of years in the US dollar has pretty much played out. I'm expecting to see the dollar be reasonably firm against some of the other major currencies going forward over the next couple of months or so. We've seen a big decline in the dollar against most other major currencies, and we're now expecting, I think, to see interest rate differentials narrow, and that's going to be quite supportive of the dollar. We've also seen some of the yen carry trade unwinding again, which is quite supportive of the dollar.
Peter, we were talking a little earlier about some of the positive economic data that's expected to come out of Japan next week. Most notably, the Tonkan is coming out on Thursday, and that's expected to be the best showing since 1991. Could this support the Nikkei, Japanese equities, and then see foreign funds flowing into Japan to buy shares? How much support would that give the yen?
Well, quite frankly, I think the big flow of cash into the Japanese equity market was really in the early part of this year, and I suspect we're not going to see a repeat of that, and if anything, you may see a little bit of foreign selling. But on the other hand, I think what we are going to see is in the Japanese bond market. In fact, last week's data suggested that Japanese institutions are selling foreign bonds and buying back Japanese bonds, and that flow could be quite significant significant. So I think what that's going to do is be relatively positive for the yen as we see Japanese institution flows back into the yen rather than foreign institutions buying Japanese equities necessarily.
Peter, good morning from Mark here at the Singapore Exchange. We're just getting some flashes here from Dow Jones Newswires. The Monetary Authority of Singapore, according to traders, is looking to cap the US dollar versus the Sing dollar at 172.10 to 172.20. The Monetary Authority, as is convention, is saying it's not commenting on market operations. Just on the off chance that you had a thought about this, I thought I'd pop you the question.
Well, I think Singapore has always been managing its currency very carefully over time, and I think with the numbers that we're seeing at the moment in Singapore, we're looking at very strong export growth. We're seeing a pretty strong economy. We're seeing domestic consumption picking up a little. We haven't seen a big pickup in asset prices in Singapore. So the sense here is, in my view, is that we're not going to see the Singapore authorities do anything much in the way of interest rates until we see some kind of pickup in asset prices, which we haven't really seen yet. If we look around the world, and Britain and Australia in particular, it's been the asset price bubbles which have driven interest rates and are going to drive the currency from here.
Peter, when we were having a chat in the break, you made some interesting comments about the property market in Australia and also over in the UK, and how Forex investors should be keeping a close eye on that. Can you tell us about it?
Well, absolutely. Certainly in Australia, I think we're going to see, I think, a significant reversal. We've seen definitely the peak in the Australian dollar, and I think we're only going to see further downside from here. And there are a number of factors in this. All of the reasons that people were long the Aussie dollar have pretty much all reversed. We've seen probably the peak of the commodity cycle. We've certainly seen probably the peak also of the Chinese growth cycle. That's going to diminish. That, I think, has been a major reason for being long Australian dollars. We've also seen the RBA raising rates, so we've seen a big yield differential. That was a big plus. But now we're seeing, I think, all of those things reverse, and the property market is also starting to come off. That creates a lot of domestic uncertainty in the economy. Will demand hold up in the face of this? Will we see balance sheet problems amongst the consumers and amongst property companies in Australia? It creates another leg of uncertainty there, which I think will be reflected partially in further downside pressure in the currency.
Interesting. Okay, Peter, thank you so much for that. And thanks for sticking around for 3 separate interviews with us today. We appreciate your time.
Not at all.
That was Peter Churchouse, U2 Advisory Director with Morgan Stanley, joining us live from Hong Kong.